Good morning. You're watching the market right here on ET Now, and coming out of another volatile week, we closed sub the 17K mark on Friday's session. 16,955 thereabouts was the print where we shut shop, and once again it was the global factors bogging us down. This week, while of course it's a truncated one, you've also got the financial year closing, remember, on March 31st. You've got FIIs expiry as well this week, and D Street is also going to see the effect of grandfathering in debt funds, that also getting absorbed. So lots on our plate, even though we've got just 4 trading days to cope with.
It's just one of those weeks where you may not be resigned to a particular event per se. There would be a push and a pull element. Year-end ending, which could have impact on some NAVs or window dressing. B, you got an FNO expiry in a truncated week. So you put all these things together, you may not see too much of market movement based on news per se. But yeah, the markets have been volatile to say the least. You getting support at closer to 17,000, but 17,200, 17,300, this market is running into a resistance. I don't think this market is nervous, but this market clearly is not excited. Globally, one thing is evident, that the challenges in the US financial sector that clearly have not snowballed into some kind of a downward spiral. So that's a relief on that front. B, the print, at least on commodity and the US macro data, seems to be indicating that worst of the inflation is behind us. That is also a relief. But locally, I don't think the markets per se are really excited about something really big to look forward to. It's too early to say that for individual stocks the bottoming process has started, but a lot of brokerages, we'll talk about it, have come out and they've raised a green flag or a yellow flag, saying that now it's time to examine the market closely, because markets are nearing what could be called as a valuation bottom. That's the word. Are you nearing a valuation bottom, or are you still a distance away from the valuation bottom? That's the only thing that matters.
But the FI selling still hasn't abated.
And I don't think it'll abate in any kind of a hurry, because there are a lot of compulsions which clearly are at play. You got hit because FIs were selling as they were getting a market like India. 2022 FIs were selling because they were booking profits. 2023 they were selling because money was moving out of India to China, and currently there are these bond losses which in a sense are forcing foreign institutional investors to really hunker down their outlook towards emerging market. So there is a lot of compulsion which is at play, which is in a sense forcing foreign institutional investors to sell. Why do you sell? You sell because you think that markets are expensive, which Indian markets are not, or you got redemption, or you need to do risk management. I think the latter is at play. The whole narrative that India is expensive, I think, is over. India was expensive. Now there are technical compulsions which are at play, and it's anyone's guess that how long the technical compulsions would be at play. But my limited point is that you're nearing that moment in the market, or that turn in the market, where the downside purely based on valuation is limited. If you have bought stocks at these levels historically, the chances of making money are far higher than chances of losing money. Similarly, last October, December, if you bought into stocks, the valuations were so stretched that the historical averages are indicating that you need to be either a seller or you need to book profits. Now, whether it's a 5% decline or a 10% decline, that's a risk appetite, but directionally you want to be a buyer. If you're sitting on cash, start putting money to cash. I'll stick my neck out and say that the risk reward ratio now, the beam balance, is now tilting towards reward rather than risk.
That's exactly the word. Most of the brokerages are also saying that the risk reward is looking much better than what it was earlier, because remember, India was trading at a huge premium earlier. That has narrowed down considerably, and that's the word coming in from Citi, Surinder Goyal as well. He's saying that the valuation has now become reasonable. Even Amit Shah of BofA has said that buying on dips is perhaps the best strategy at this point of time, and they're looking at buying Nifty at 16,000. We are almost 1,000 point away from there, so not anywhere close, but still, that's the word coming in from BofA. CLSA also believes that the bearish indicator was 91 1%, which means that it's a good entry point at current point. And even JP Morgan is saying that the Nifty's headline PE is now back at 2018-2019 levels. So the the premium that was there to the S&P and the EMs, that has contracted substantially, and that seems to be what working in the favor. So Nikunj, risk reward is something that you pointed out is already turning a tad bit better, but there are now downgrades, etc. also coming. For instance, this morning there was on M&M, and stock specific, it's becoming a lot more difficult to find those narratives as well. Do you think it's going to be a lot more difficult in 2024 to make money versus 2020, despite valuation at the index level being cheaper? Stock level, it's going to be more difficult?
Nisha, the way I look at the market is that I think that the second half for this year will be dramatically different than the first half of this year. And a lot will actually start settling down towards the second half of this year. We will pretty much get a sense where inflation is headed. We pretty much would get a sense that, how central bankers in a sense have really, what kind of approach they really would be having. The base effect of low commodity prices, I think, will start kicking down. A lot of commodity producers which have had a terrible patch, so to speak, because of high commodity prices, I think that also eventually will be behind us. Another 6 months, this market suddenly will start looking attractive, largely because then we will start talking about FY25. We've not had any returns in last 18 months. Another 3-4 months of no return, that automatically will make the market look attractive. Now, when it comes to individual stocks, we'll talk about the themes which would be at play. But in general, I think the second half of this year should be much better than the first half of this year. I think this market reminds me of what we saw in 2013-14, where the market gave you 2 years of no return. It was largely because of global taper tantrum. It was largely because of flows which got adjusted. But when you emerged out of that so-called, months of consolidation volatility, there was a ranked outperformance which was there in mid and small cap stocks. And India outperformance, I think, was visible. I can see traces of what I saw in 2013 and 14, where you will see a lot of underperformance, not because of local factors, but because of global factors. You would enter into a no return patch of 15 to about 18 months. 18 months already done. Another 3 months, you add back 2 more quarters of earnings, and suddenly you would say, FY25 market sasta ho gaya. Which means that markets will start preempting FY25 in the second half of this year. Now, whether that starts in August or September, I don't know. But my case is that second half of this year will be better than the first half of this year.
Okay, on that note, let's hear out what Nilesh Shah from Envision has to say. In fact, he's been liking the HDFC twins. He also likes the insurance space, and particularly actually likes HDFC AMC amongst the AMC names.
I think the HDFC twins, I think they look good, especially post the merger. I think they should look good. So that pack looks extremely good. You could even kind of say ICICI Bank or anything like that. I think some of the defense names like Bharat Dynamics or Bharat Electronics, some of these names which I'm taking, we own in our PMS. I think these kind of companies they look pretty good. I think from at least even a 1 year or even from a 1 to 3 year perspective, these kind of large cap names look good. Some of the names in the insurance side, names on the mutual fund and asset management company side. I mean, we own HDFC AMC. I mean, yesterday it was trading at 25 times trailing earnings. 25 times trailing earnings for a business where the penetration is just about 2-4%. You're going to see more and more people and investors come in and participate in SIPs. And a business does not need capital. On a base case, this business has 10 to 15% likely earnings growth, or 25 to 30% return on equity. So highly capital efficient business, and a business which could keep growing for the next 5, 10, 15, 20 years, and trading at 25 times trailing earnings. Okay. Probably the peak was at 50 times trailing earnings versus that is 25 times trailing earnings. I'm saying these kind of stocks look extremely good. They may not create fireworks for you, but would they be good place to be in from a 1 year plus perspective? I think so.
Well, let's track the technicals of the market. It's going to be an important week as we have the monthly options expiry, and that's going to happen a day ahead of schedule because it will happen this time on Wednesday. So let's try and understand how things are settling in. We have CA Rudramurthy joining us, the MD at Vachna Investments, to talk to us about the trend there. Hi Rudramurthy, good morning. So 16,950 thereabouts is where we close, but for the week, do you expect a big upside, or do you expect that we'll continue to be in this range of 16,900 to 17,200?
Very good morning. I feel Nifty is definitely facing resistance on every rise. Levels around 17,120 on Nifty future is a very crucial resistance now. And even if you break that 17,120, you will see multiple resistance kicking in at 17,230 on Nifty future, and then eventually 17,350, which was acting as a strong support before. So for me, till we go above 17,350 decisively on Nifty future, market still remains a sell on every rise. And the last support now left out is 16,800. If we break 16,800 on Nifty future, you will see a free fall. Also, if you see how markets are positioned on derivative data, there has been a huge call selling happening on every higher levels at around 17,100, 17,200, and even 17,000 levels call writing is seen. So this indicates that at least the upside is capped for short term, and any downside below 16,800, you will see a steep and faster fall because supports don't emerge anytime nearby below 16,800. So for me, it is a sell on every rise market. If you are a buyer, wait for 17,350 to break and market trend to reverse, or else I said you have to be very stock specific. Markets are not giving you good signs of any positiveness, for me at least on chart.
Okay, so in that light, Rudra, do you have all sell calls?
Yeah, in fact, I'm just picking a buy and a sell call. I want to wait out for that 16,800 to break before I sell and before I take aggressive sell calls. So for me, there is a buy call definitely possible right now on a stock like Zydus Life. Zydus Life is making that patterns on chart where strong support is emerging to this stock at around 475, 480 zone. Risk reward is very good to buy at current price, available in F&O. So I want to buy Zydus Life for an immediate target of 500, keeping a strict stop loss of 470. Banks and NBFC looks weak. But don't sell ICICI, don't sell HDFC Bank, which are stronger. Look at weaker banks, something like RBL Bank, Indus India Bank, Bandhan Bank. These are all good shorting candidates. Sell on every rise. Today you get an opportunity to sell on a gap up also. So for me, RBL Bank is a sell. Look at initial targets of 125 and keep a stop loss of 142 for the same.
All right, Naresh, are we in for a good day of trade, or it's going to be one of those weeks where you go higher, you get into resistance, you go lower, you get into support?
So I think till the time we are stuck in that band of 16,800 to 17,200, that is what we expect, that the choppiness and the ping pong in a range continues. What we are seeing is globally also it's the same. We are ending up at the same place after all the volatility, all the news around. So I would expect the same, and I would rather be watching out to be a reactive trader going forward, wherein once we cross 17,200 or 16,800, that is where you change stance. Till that point of time, expect this small range to continue.
Okay, and if you had to pick out some stock-specific recommendations, Naresh, what would your top bets be at this point of time?
So continue to be defensive. So first is a buy on HDFC Bank, which is bouncing back from that 1530, 1550 gap mark. A risk reward seems better at these prices. A stop loss at 1530, expecting a small bounce back towards 1650. Second is a buy on NCC Limited, one of the few stocks which is clearly showing strength, and also the whole sector. So it's the whole road construction space looks interesting, even in such a market where there is not momentum. This whole sector has been doing well, whether it is NCC or HG Infra. So I'll pick up NCC with a stop loss at 98 and a target price of 120.
All right, now that we've got complete crystal clear clarity on STT on options, it's going to go up by nearly 25%. Let's understand that what implications it will have from 1st of April for an option trader, and could this really impact the volumes? Chandan Taparia, good morning. Thank you for joining us. In your understanding, when the new financial year will start, which is a week from now that the STT on options has gone higher, will this impact the arbitrage activity?
Good morning, Nikos. Thanks for having me. So, in the recent amendment, the government had hiked STT from 0.05% to 0.625%. So, accordingly, on transaction of 1 crore, earlier STT used to be 5,000 rupees. Now it will be 6,250, so up by around 25%. Now we need to keep two things in mind. This STT is calculated first on sale of options, and for calculation of STT, we take the option premium, not the lot value. So let's say, for example, if someone is selling one lot of Nifty at premium of 100 rupees, STT will be calculated on option premium, right? So that is not much bigger if someone is doing in the small quantity. There is no harm for the people who are into the retail segment and buying the options. But yes, those who are doing in the high frequency trade, those who are working on arbitrage, and those who are the scalper, definitely their yield are going to hit. So because of that, we believe that on short-term point of view, as their yield will decline, so their transaction or trading activity will slightly go down. But at the same time, I don't see major reaction in the volume decline because of this. Definitely government revenue will increase, but those who are working on the high frequency trade and algos and arbitrator speculators, their trading activity is going to decline because of this change in the 25% hike in security transaction tax.
So, okay, Kamlesh Shah also joins us now. Kamlesh, what we're trying to understand is that the long-term implications of the new increased STT. Do you think this is something which markets will negotiate? Because I remember in 2004, 2005, when STT was introduced by Mr. Chithambaram, everyone thought that, okay, volumes will dry, this is the end of the trader, this is something which will be draconian. But that has been digested by the market. Now STT is par of everyone's life. Do you think this also will be adjusted by the market going forward, Mr. Shah?
Yeah, good morning. The market will definitely adjust, as you rightly pointed out. However, whether it is appropriate or not, whether it is desirable for the market or not, that's a big question. When it was introduced in the lieu of long-term capital gain, and it was treated as an TDS, and the tax rebate was given. Now, even long-term capital gain is in place, and the benefit under 88E is also withdrawn. When it was introduced, it was 500 rupees per crore. Now it is 6,250 rupees per crore. So, this will offer many transaction cost arbitrage between Indian market and the overseas market. So the overseas player who are HFT players will find it difficult to trade in India. As it is, the margins are so very wafer thin in the intraday market that, this will put additional burden on the traders, and the margin will further evaporate, which will, take them away from the market. Market will definitely digest. However, it's a matter of development or growth of the capital market. Even in spite of this high transaction charges, which is one of the largest in the world, the market may grow, but it may grow at a lower pace. Say, for example, if market grows by 20%, we all will be happy that the market has grown in spite of high STT. But it had potential to grow maybe more than 2 times. So we should not be happy. Secondly, the tax has to be reasonable level. Now, this kind of levies will always discourage participation in the market. The investor base is growing. We have new set of investors which is participating. Last 3 years, the market has grown substantially. Retail participation has increased. The new age investors have come in, and there is a lot of intraday activity in the market. Now, if you take everything put together and the growth of the capital market, Prime Minister's vision is to see that trade in India happens. Now, with the kind of cost which is highest in the world, people would find it difficult to trade in India. And ultimately, this will not be in the interest of the market.
You know, and the timing of this implementation is a little bit of a shocker considering how fragile the market is right now. But let's see how the market absorbs this. Kamlesh, great to have you on the show and given that clarity as you did on Friday as well. And Chandan, good to have you on the show too.
Thank you very much.
Okay, let's talk stocks. While the SGX Nifty, deriving from the global handover on Friday night, is indicating a 17K start. Let's see what are the stocks which are going to be in focus this Monday morning. And Credit Suisse has upgraded Sun Pharma to an outperform. Let me take it across to Pankaj and find out what's the rationale behind this and whether or not they're upping their price target as well. Pankaj?
Absolutely. You know, when we just look at Credit Suisse and Sun Pharma, they have upgraded their rating to outperform. This comes in after neutral rating and their target price is 1150 now, which means the upside that they believe now is close to about 180 to about 190 rupees. Specialty platform has emerged as one of the key growth drivers, and that, according to them, is one of the key things to watch out for. Company targets to double its specialty sales over the next 4 years, and that they believe will lead to a lot of margin expansion. In fact, talking about margin expansion, they are saying that India business valuation provides the downside, but at the same time, when you just look at the margin picture, the company is entering into the phase where capex is going to come down and margins are going to increase, and that's their main key call. As specialty sales increase, capex over there reduces. That is something which will enhance their margin, and that is something which will re-rate the stock. 1150 is the target price. It's a new upgrade which is coming in from Credit Suisse on Sun Pharma after being neutral for really a long time.
Okay, taking a bet on the margin expansion story and the leverage available there. That's the word coming in from Credit Suisse. Thank you, Pankaj, for joining us with that detail. But shifting focus to what's happening in the banking sector, and let's see how India is actually addressing the global banking turmoil as well. Union Finance Minister Nirmala Sitharaman met with public sector banks to review the health of the banking system in India. Prakash Priyadarshi is joining us with the key takeaways of the meeting and what actually transpired. Hi, Prakash, tell us what really happened.
Yes, the finance minister has held an important meeting with the public sector banks on backdrop of a stress in banking system in the US and Europe. FM has reviewed the preparedness of the public sector banks to deal with the current situation. Finance minister was apprised by the public sector banks that they are ready to handle with any emerging situation given a strong governance and regulatory framework. As per the finance ministry, review was focused on PSB's preparedness on risk management, diversification of deposits and asset base. Other than that, FM has also reviewed the exposure of the public sector banks to the developing external financial stress from both short-term and long-term perspectives. Apart from that, FM has also asked the public sector banks to monitor their business model closely to identify stress points. Banks have also been advised by the finance minister to leverage the full potential of the branches open in the GIFT city to identify international opportunities. Since it was first full-fledged meeting with the public sector banks after presenting Indian budget for the financial year 2024, banks were told to increase credit growth to the productive sector, including enhancing credit outreach in states where credit outflow is below than the national average. Apart from that, FM has also asked public sector banks to prepare strategy to increase their business presence in new and emerging areas like one district, one product, ENAM and drones.
Okay, we leave it at that. In the meantime, Reliance Capital resolution plan has hit another roadblock as bidders are pretty upset over another auction plan. In fact, ET now has learned from sources that Hindujas have asked to consider lower the bid at 8,100 crores, while Torrent has shown its unwillingness to participate in another round of bid. Ankur Mishra, my colleague, is here with all the details on the same.
Yes, Reliance Capital lenders seems to be in a fix because both the bidders have kind of conveyed a cold response towards the second round of auction which was set to be conducted this week. Now we understand through sources that Torrent has conveyed that it does not want to participate in the fresh round of auction while its plea in Supreme Court is already being heard. However, it did not get any interim stay on lenders conducting fresh round of auction. On the other hand, another bidder which was Hindujas Group and which had claimed to have submitted a bid of around rupees 9,000 crore in the last round have asked lender to consider its earlier bid of rupees 8,110 crore. Now this is interesting because sources say that the bidders are weighing the company little lesser due to the announcement which has been made in the budget on the insurance sector. Now after that it will be interesting to see whether or not lenders go ahead with the second round of auction or not. The lenders are going to meet today to decide on future course of strategy, and we understand that they will also once again talk to the existing bidders on the participation on the latest round. The lenders were looking for a base bid of around rupees 9,500 crore, and so if sources are to be believed, Hinduja's offer of rupees 8,100 crore falls much less than that, as lenders were aiming to get as close to as possible towards the liquidation value of the company, which is pegged at rupees 13,000 crore.
Thank you, Ankur, for joining us with the latest on that story. But even though SIP cancellations are on the rise, Aditya Birla Sun Life AMC MD and CEO A. Bala believes that there is nothing to worry about since new registrations are also increasing.
Cancellation is actually the function of the market sentiment, and I think it's a business as usual kind of things. The ratio only can differ from the normal ratio in the cancellation is roughly about 30-35%. Okay, every time. It's nothing new actually. Now I think people are just looking at the number and then saying SIP cancellations are high. Historically, you have seen, I think the way you have to look at the SIP number is in two ways. One, how many number of people actually keep on buying SIP? That's called SIP registrations. That's gross number we call it. If you look at the trend, SIP registration numbers have been going. The 13,800 crore that you are saying is SIP registrations. Though cancellation would be there, but I think the net level, if you look at it, I think net number is a positive, which is what I think is the case currently. Then we should not worry about it. They also cut down their exposures. Also, given the fact the fixed income is also equally attractive today and compared to the debt, given the fact levels are high as for the interest rate concern, there will be a set of people actually stopping the SIP and moving towards, not stopping SIP, they will be moving towards fixed income as well. So, this is the function of the rates, the function of sentiment, and also the function of how actual business, how the book is being built.
Okay, let's discuss some of these. Stocks which are going to be in focus this morning. And, our colleagues was just highlighting as to how the FM meet with the bankers actually went, and PSU bankers, that is. But Rudra, if I could just highlight what you're witnessing on the Nifty Bank, and, is that looking weaker than the overall index as well?
Yeah, Aisha, in banking, if you clearly observe, banks like RBL Bank, banks like Indus India Bank, Bandhan Bank, these mid and lower tier banks available also in F&O are much weaker. But however, if you see banks like ICICI Bank, HDFC Bank, they are comparatively stronger. But overall, if you observe banking index as such, definitely I see weakness. You can also see on Friday, markets on Bank Nifty closed more or less closer to the lows of the day. If you observe Bank Nifty future, the low on Friday was 39,340. And if you see the close, it is hardly 40 points away from there. So this is indicating to me today's gap up, whatever you might get. And as indicated by SGX Nifty, I won't be surprised if we get that gap up getting sold into. So if someone wants to take positionally sell call, look at weaker ones like RBL Bank, Indus India Bank, Bandhan Bank. So these are better banks to short. I will definitely avoid shorting ICICI Bank or even for that matter HDFC Bank. And also NBFCs are showing weaker signs. Might be that is because of the debt mutual fund revised things which came on in terms of that LTCG fundamental news. So for me, if you even look at Bajaj Finance, look at even stocks like AB Capital, look at even, for example, HDFC, AMC. So these are all areas where you are seeing more weakness. Even for that matter, LIC Housing Finance looks very, very weak for me. So if you want to look at shorting opportunity, I have given a lot of names here. So these are better ones to sell. But for me, definitely sell on every rise is what index is indicating, both at Nifty and Bank Nifty levels.
Okay, Rudra, that's a word coming in as far as how one should approach the Bank Nifty as well as some of these financial ancillary names. But let's get a fundamental bet as well now. Listening to the top bet coming in from Sanjeev Bhasin. He's quite positive about Sterling and Wilson Solar.
SW Solar is the largest EPC player in the world. It is the sole agent for providing EPC and MEP for any solar panel and PVs. And Reliance Energy now has a 40% stake. I just had a conversation some time back with the management. They had an order book of 800 crore till last year. This year they are executing 4,000 crore. And by next year, it can even touch 10,000 crore. They have a margin of 11 to 12%. So you can imagine the bandwidth this stock has to create wealth. It is just an 18 crore equity. Reliance Energy owns more than 40%. And if you do your homework and sit still for 1 year, I can guarantee you this year it will be a double. If you wanted to pick particular stocks in your portfolio, then I think stick with the large caps. Dr. Reddy and Sun are two large picks. Lupin has always flattered to deceive, but now the management seems very keen on increasing market share. Their generic pricing are improving, and I think they've been through a lot of the problems. So at 700, I think that gives you a very good risk reward.
Okay, a lot of stocks in focus this morning, and CG Consumer and Butterfly Gandhimati are all set to merge. The move comes in almost a year after CG Consumer picked up controlling stake in Butterfly. Vinny's here with all the details.
Absolutely. Now, this announcement came in over the weekend where Crompton Greaves Consumer Electricals said that they have announced a merger with Butterfly Gandhimati. When you look at the deal, for public shareholders of Butterfly, they will receive 22 equity shares of Crompton Greaves Consumer Electricals for every 5 shares held. Now, at the current market price, when you look at it, it's the deal is at a par value for the holders, public shareholders of Butterfly Gandhimati. Now, other than that, what the company is also highlighting that the proposed merger is expected to be EPS accretive from the first year itself, and overall the implementation of the scheme will take 12 to 14 months, subject to the receipt of the approvals that they require from the requisite holdings as well as the requisite companies that are required to give the approval. Now, overall, other than that, when you look at it, why is the merger there? So now this merger actually will lead to a benefit in terms of revenue, cost synergies to be realized over the period of short-term to medium-term time, as well as they're providing impetus for growth across all parts of the country as well. Butterfly Gandhimati has a strong presence in the south as well. They can leverage their distribution channels in different parts of the country, which will benefit both of them as well as they will be mainly driven by the human capital and diverse skills that is there. That will also be a benefit for both the companies as well, and this will enable for more efficient capital allocation as well as result in simplification of corporate governance. So let's keep an eye out on this merger deal that has been announced.
Okay, thank you, Vinny, so much for that. And since the call is underway of Butterfly Gandhimati as well as Crompton Greaves, we'll wait by to get more details from that con call as well. But welcoming on board Sandeep Sabharwal this Monday morning. Sandeep, hi, very good morning to you. Let's start with the entire consumer durable space itself, right? The unseasonal rains seem to have marred the sales of, ACs and cooling products for the time being. Though at the start of the month, we were talking about how there's a heat wave as well. So a bit of a mixed, kind of reaction coming in for the sales at the moment. What's your take if there is any stock which you would want to recommend from the entire space that stands out?
The consumer durables is a beaten down space right now. So we've seen the impact of inflation and post-festival season slowdown in demand impacting the stock prices. So many of the stocks are reasonably placed. So to that extent, so there was a flurry of activity in summer-related stocks, and that's why investing on the basis of weather predictions always is very difficult. So some people bought in the expectation of a heat wave. Some people are selling some stocks in the expectation of El Nino, but no one knows what's actually going to happen. But I think some of these stocks like Voltas, Havels, Crompton Consumer, etc., I think they are in reasonable zone from a risk-reward perspective. In terms of downside risk to upside potential should be 1:3. So there could be potentially a 10% downside if things go wrong and markets sell off. But as things stabilize and demand comes back, we could potentially see a 25-30% upside in many of them.
Right. Sandeep, also wanted to understand whether time has come to spot opportunities in pharma. I mean, I remember you do track Sun Pharma. Credit Suisse has come out with a report this morning. They're upgrading Sun Pharma to an outperform with a target of 1150. Getting selective in pharma, you think, is the right call right now?
See, pharma is a sector which is flattered to receive. So there are very few companies which have done well consistently. And some of the companies who were doing well, like Cipla, etc., suddenly the performance slipped. So it's a difficult sector to participate, especially given the price pressures all across. So the only stock we own is Sun Pharma, where the company has been doing consistently well. Smaller pharma companies have a lot of issues, and overinvestment is one of them. So I think they will see more profit pressures going forward. So if at all someone wants to buy, I think it's better to stick to stocks like Sun Pharma or possibly Dr. Reddy's, etc.
Space, which is the flavor of the season, is all the infrastructure stocks, right? It's end of the financial year, and then we have the election coming up next year, and there is this increased clamor around how there's a lot of order inflow. We've seen, of course, BL getting 4,300 crore worth of orders in last 15 days. Likes of GR Infrastructure, HG Infrastructures have also reported good order inflow. Is there any name from this space, Sandeep, that you would want to specifically recommend?
In infra, my interest is more in companies which are more on the EPC side rather than those who are taking up assets for building like HAM, BOT projects, etc., where we've seen huge risks in the past. And I think these companies will face risks related to higher interest rates and lesser liquidity also. So among the companies which are into pure infra development or pure construction, I think the leader of the pack, L&T, I think it will still continue to do well. It's been winning very good orders. Then as a flow through, NCC has been doing well. So I think that's one company which should do well. On the water space, there's V8 at Webag, which has won good orders and good orders in the pipeline. So all of these companies have moved away from asset ownership to more of EPC and cash flows. And that's what is important in the infra side.
Sandeep, what do you think is going to be this impact of SCT on sale of options, which has been hiked to 25%? You think it's going to massively impact the volumes in an already fragile market?
I don't think it matters too much. People always crave about small increases in taxes, etc. Some volumes, even if they go down, and if some people actually save money not doing excessive trading, I think it's better.
Okay, fair point. Sandeep, stay with us. Let's also take a look at PI Industries. That's another stock which is in focus. The management met. In fact, one of the brokerages has listed out the key takeaways from their management meet. Ashesha is here with a quick summary.
Absolutely. So BNK Securities met with the management of PI Industries to be appraised of the current developments that are taking place in the agrochemical industry, both in the domestic market as well as in the global market. First up, they've spoken about their growth plans, where they say that management has strong visibility of growth in the existing product portfolio. They say visibility of growth is also underpinned by development and commercialization that is happening in the non-agriculture product space. Moving on to the company's management guidance then, where where management reiterated sustained growth guidance of more than 20% despite the headwinds that we are seeing in the global agriculture space. PI Industries, remember, has a track record of overachieving its guidance, and the management continues to give conservative guidance even now. As far as competition is concerned, management said that competition in agrochemical CDMO business is now beefing up, and company is working on multiple non-agriculture inquiries as well. As far as inorganic plans are concerned, the company said that it is in advanced stages of discussions to finalize their inorganic growth plans, and BNK Securities for now has maintained its buy rating on the stock with an unchanged target price of 3,690 rupees per share. So on account of these takeaways that have come in from the management meet, keep an eye out on PI Industries in today's trading session.
Okay, Asesha, we'll definitely keep an eye out on PI Industries, but then there are other stocks which are there on editor's radar this morning as well. We have two brokerage notes coming in. On account of that, M&M as well as Kotak Mahindra Bank will be in focus. Let's start with M&M first, Nikunj. This is that darling of stocks of 2022, was up over 50% last year. But now finally there is a word coming in from BofA that perhaps risk-reward is now a bit neutral.
There are two things which work for Mahindra. The change of guard, they exactly did what the Tatas did in terms of a large group, multiple subsidiaries, squeeze out the inefficient and scale up the efficient ones. That's what they did, and that was empirically visible in some of the tough decisions they took. For example, exiting SsangYong, reducing exposure to some of the non-core low return businesses, and then focus only on the SUV business. Who would have thought 3 years ago that SUV business in India or SUV sales in India would be 40% of the total sales? I mean, India was always supposed to be this whole bottom of the pyramid market, where bottom of the pyramid, Sasta, Sundar, Tikau will always do well. When you're looking at SUV, it's a complete change in mood and complete change in mentality. It is like, power and brute force at affordable price. So there has been a change in narrative for Mahindra and Mahindra, which did exceedingly well for the stock. And then there was a EV investor. Now what's next? Tractor sales, monsoon impact, higher valuations, very well discovered. So I think Mahindra and Mahindra now runs the risk of maybe either underperforming or moving into some time-wise correction for a long period of time, because from a market standpoint, a lot of news what we're discussing today and a lot of good things what they've done today is something markets have factored in, let's say, in last 1 year. Look at the stock, 52-week up in last 1 year, when markets in last 18 months have given no return. So in a no return market, if a stock goes up 50%, that just tells you the outperformance it has had.
Clearly a massive outperformance, but then let's shift completely different to the stock which has underperformed massively. If you look at the 52-week chart, that will tell you that the stock has done nothing. Perhaps a marginal negative return is what we should be expecting for Kotak Mahindra Bank. Yes, down about 2%, but finally there is some light at the end of tunnel that it seems to be the case, because there's an upgrade coming in from CLSA this morning and suggesting a 25% upside.
Why did the stock underperform? Again, if you look at the Bank Nifty into contrast with what Kotak has done, the Bank Nifty in last 1 year has done reasonably well. And yet if Mahindra and Kotak has not done well, that just tells you that the stock not only has given no returns, but it has given no returns when the index per se or the sector per se has got massively re-rated. That's the Bank Nifty of 10%. Kotak Mahindra Bank in last 52 week is down 12%. Now this used to be the halo stock. It was expensive, FIIs are selling, but more importantly, they had a dim outlook of economy. They were not really lending. And as a result, they were not expanding their book post-COVID. Is there a realization there? A. B. Now with Kotak Mahindra Bank, markets in a sense have always associated Mr. Kotak's face as the real decision maker there. Now, how will the succession plan move for Kotak? Will it be internal? Will it be external? I hope it's internal, because the understanding of the book is better. The stock has got, the business has no problem per se. Now you can see that they've started lending. And typically when you're in an environment like this, when you're talking about global crisis, NPA, H2M losses, banks like HDFC Bank and Kotak, they do very well. This was the same factor which was at play between 2015 and 18 when the sector was going through a huge crisis, and only two stocks which did well, Kotak and HDFC. I think we're raising that face again.
Oh, well, yes, the quality of the book finally comes to the forefront when there is a turmoil like this, and Kotak is known to be very conservative when it comes to their lending as well. Was the reason of the underperformance, but could that be the reason of outperformance? At least CLSA is banking on that. With that, it's back to you, Aisha.
Okay, in the meantime, that aside, or rather the view on Kotak Bank aside, Mr. Uday Kotak has actually tweeted, and let me just read that out to you. He's stating that NBFC resolution, Reliance Capital, Shrey Infra experience signals very poor recovery, below liquidation value for creditors, stating that the NCLT process is also tardy, whether IBC or otherwise. He's saying in IL and FS2, while recovery ratio is better, legal process takes long time for policy relook at the financial sector resolution level. But let's talk some more stocks which are going to be in focus. And Sandeep, Nikuj was just highlighting his views on M&M. Do you also think that the stock could very well go into some sort of time-wise consolidation after an excellent last year? Sandeep?
Yeah, I lost your audio. So you were asking about M&M, right?
Yes, I was asking about M&M. And do you think that at least in the interim, the best could be behind us in terms of its outperformance last year? And could we see some time-wise consolidation in the stock from here?
So it's possible because too many analysts are turning negative on a possible El Nino and its impact on M&M. So to that extent, I think it's possible that the stock consolidates. But I think the moot point is missed by most of the analysts, and which are the long-term drivers, which is the quality of their product profile, how they have changed the products as per the changing requirements of the customers, as well as the direction in which the EV evolution is going, and their continued outperformance on the farm equipment side also, where farm mechanization will only increase going forward. So there'll be blips here and there, but and the stock is still not very expensive. So such phases where analysts turn negative are typically good for good quality companies, as it gives opportunities for investors who have not invested to possibly buy cheaper. Longer term, I don't see much issues in the stock doing well.
Okay, so for the long term, M&M is still a good bet. That's the word coming in from Sandeep. But which are the stocks that Neeraj Dewan is betting on? He likes a couple of names with the entire infrastructure theme around it. Let's find out those names.
L&T among the infrastructure space has been doing quite well. And in last quarter, you see execution picking up also. Order books are very good, whether it's L&T, like you flashed NCC also, there also order books are very good. But, among the other companies, we've been bullish on Kalpatru Power. JMC's merged into it, so it's become a bigger company. So that can continue doing well. Some of the companies which are into water and related space, like Ion Exchange, they are doing well, and they've also corrected from the high of 3,500 odd that they saw. We've already seen 10 to 12% correction in those companies. And, even in the pump space, Kirloskar Brothers is one company which we like. The company have been doing well. Their margins are also picking up. Their, volumes also picking up. So there also that valuation comfort is there.
Sandeep, any specific reason why in your book, Kotak Mahindra Bank, at a time when entire banking sector per se has done cartwheels, has given no returns? No returns for a stock at a time when the sector per se has been charged up. It's quite amazing.
I think there are a couple of reasons. One is that the macro calls of Kotak Bank's top management have gone more wrong than right. So I think they turned very conservative at a time when other banks actually lent out aggressively and saw no NPA accretion. When Kotak was very conservative, they thought the economy will go into a tailspin and then there's possibility of losing money. The second is that I also looked at Kotak Bank from an investment perspective, taking into account its huge underperformance. But then I still see that it trades at 50 to 60% premium to both HDFC Bank and ICICI Bank still, which I don't think is deserved. So I don't think Kotak Bank deserves to trade at such a huge premium to these two. And to that extent, there's a possibility that despite the sharp underperformance, it could continue to underperform.
Okay. 1690, that's Kotak Mahindra Bank for you. Nuresh, Kotak Mahindra Bank, अच्छे दिन कब आएंगे?
It's a tough call because the stock has gone nowhere. So the problem is, if you look at the last many months, the stock just goes to 1650 and bounces back. over the last maybe 2.5 years now. So technically, waiting for it to actually give a price indication, say right now the only case we have is that it's not breaking that 1600, 1650 mark. So if it holds on yet again this time, maybe finally we could see a bounce back again to that 2000 mark eventually. But the bigger trend starts for the stock once it crosses 2000. Like the stock at current levels, purely on a risk reward basis, because the stock has already gone through a phase of almost more than 3 years of zero return. So pre-COVID also the stock was at 1650. So looking at 3 years plus of zero return makes the risk reward better for a large cap banking space stock.
Okay, so risk reward is clearly very favorable for Kotak Mahindra Bank given the massive underperformance over the last 3 years. Whether it comes out of its slumber this year or what's the timeline, we'll have to wait and watch. But one stock which is expected to outperform is Phoenix Mills. At least that is what Morgan Stanley believes, and that's why they have initiated coverage on the counter with an overweight stance. They believe that the company has a well-located portfolio, plus the fact that they are having a massive expansion program is something that should augur well for the stock. They have a target price of around 1700. But what are the other details coming in from the report? Let's go across to Amakshi to understand it better. Amakshi.
Well, absolutely. Morgan Stanley has initiated coverage on Phoenix Mills with an overweight rating, and they're highlighting that this rating is in turn based on the company's portfolio of high-quality destination mall in top metros. Now, they also have planned expansion of their retail assets from 9 million square feet that was seen in FY22 to nearly 21 million square feet in FY27. So, effectively, what they're trying to do is trying to double their rental portfolio, rather more than double their rental portfolio over the next 3 to 4 years. And this, in turn, is expected to drive an FY24 to 25 EBITDA CAGR of nearly 27%. Apart from that, they're also partnering with private equity players to fund projects through SPV level minority equity infusions, and this in turn has allowed them to expand aggressively while keeping their debt levels low. The net gearing is quite low at 23% as at December 2022. Now, the company is also evaluating options to diversify into residential as well as warehouse projects. So given all these factors, Morgan Stanley believes that the stock has a capital efficient business model, strong balance sheet, and the valuations are also appearing to be quite inexpensive. So on the back of that, Morgan Stanley has initiated coverage on Phoenix Mills with an overweight call. They've given a target price of 1,700 per share, which actually implies an upside potential of over 30% from the current market price.
Okay, Amakshi, thank you so much for that. The stock has had a decent run. It's up almost 24% over the last 52 weeks, but it's still considerably off the 52-week highs, which were around that 1600 mark as well. But let's talk about Muthoot Finance as well. That stock is in focus because it is a probable candidate to get out of the MSCI list. Why is exactly that? What are the price levels to watch, and what could be the potential outflow? Somit will tell us all of that. Hi, Somit.
Well, Muthoot Finance stays in focus on the back of the fact that the stock could get excluded from the MSCI May 2023 review. Now, this review is for the MSCI Standard Index, and as per the current global market capitalization cutoff, if Muthoot Finance stock falls below the 930 rupees per mark, then there's a high probability that the stock might get excluded from the widely tracked MSCI Standard Index. Now, do remember the current share price of Muthoot Finance is at around 965, which is at a 4% premium to this 930 mark. And if the share prices fall below this cutoff level, anytime between April 17 to April 24, that's when the that's when the cutoff dates will be. Then the stock could get excluded from the index, and the potential outflow based on the current weightage of Muthoot Finance could be to the tune of around 80 to 90 million US dollars. So keep an eye out for this stock. Apart from Muthoot Finance, there are a host of stocks that are in the list that could probably get included in the MSCI Standard Index. Firstly is Hindustan Aeronautics, which has a high probability, and if the stock gets included, then there could be inflows to the tune of around 195 million US dollars. Power Finance is another stock that is also in the list, which can get potentially included in the MSCI Standard Index, while there's a low probability of Ashok Leyland also getting included in the index, and if the stock gets included, there could be an inflow to the tune of around 104 million US dollars according to MK Broking.
All right. Sandeep, is the fear in some of the AMC stocks, I'm changing gears completely here, is slightly overdone? Ultimately, the SIP culture is strong. You know that the big picture 3 years from now, 5 years from now is only going to expand. These stocks now, let's say 2 years ago, were trading at euphoric levels. Now they're trading at depressed levels. Is it time to buy, let's say, a HDFC AMC, or for that matter, even Birla AMC?
The problem with these stocks is that one is that the regulator has been continuously cutting down on the amount of profits they can make. So the fees they can charge to clients have been cut down. Then the additional fees they could charge to tier 2, 3 cities has come down. Now there's the issue around the debt funds. So despite the SIPs, etc., the performance also of the AMCs has been cyclical. So to that extent, there's been no secular up move in the size of any of the listed large AMCs, where most of those funds of these companies have actually been underperforming except for a few, and to that extent they have not been investor favorites ex of whatever SIP you were talking of. And so I think those are the issues that are facing this industry. So I would think that I haven't looked at the valuations very closely lately, but I wouldn't play them as very long-term plays.
The dollar index is at 103, and that is something which we are not talking about it. But the fact that in this entire market adjustment, you've historically seen money moves back to the dollar. I mean, it's considered to be the safe haven. So that I think is a differentiating factor, if you frankly ask me, in this entire crisis, so to speak. Sandeep, 3 weeks ago it was only Adani and Adani and Adani. Today nobody's talking about it. From a market standpoint, is the Adani fiasco for individual Adani stocks and the impact of it on markets, is that behind us now?
I would think so. So because of the fact that the management was smart enough to actually raise equity by selling their stakes at whatever valuations were there at that time and getting money prior to these banking collapses in the US. So I think that's been a savior for the group. So I would, and for the overall market also. So I think the impact of that group stocks on the overall market per se, I would say, is behind us.
Okay, so that's the take about the Adani saga and how it's played out, probably towards the end of the news cycle. That's a word coming in from Sandeep as well. But I want to come back to the point that my colleagues were making about Phoenix Mills as well as Muthoot Finance. Rudramurthy, I wanted your take regarding Phoenix Mills. That stock had done well in the year 2022, but just went sideways in the last couple of months. Do you see a bit of an outperformance coming from here on?
Yeah, this stock definitely has strong supports at around 1200 zone. So any dips from current price to levels closer to 1200 will be a good buy. But if you see, this stock is definitely showing those patterns of simple accumulation, good for investment. From last year, August onwards till now, this stock is definitely just sideways and just showing those patterns of accumulation. So keeping that stop loss below strong support area of 1200, every dip can be bought for an opportunity, and one can look at targets of around 1550 to come on Phoenix Mill. So this is just a stock for investment. Keep stop loss at 1200, look at targets of 1500, 550 to come.
Okay, a stock for a bit of a long-term investment, that's the word coming in. But what about the new age tech companies? Nuresh, on the charts, if you had to pick one name out of the entire new age tech world, which is the chart pattern which looks the strongest?
So I would pick one which looks the place where the risk reward is the best and the consolidation is done, which is Zomato. The stock has gone through a sideways period of last almost 10 to 12 months. And in between, it has seen a good amount of bounce back as well. So the low was around 40. The low in May of last year was around 50. The low recently in December was around 45. The stock is available at 50. The interim highs between are 70, 75. So that's the range it could go with. So at 45, 50, there is an upside possibility of 75 in the medium term. And the longer term, once it crosses 75, a bigger trend starts. But at these prices, that's the one stock which has actually come to a very risk reward zone and a good enough consolidation done.
Okay, Nuresh, from the entire pharma space, which are the stocks that you would want to bet on? Because clearly that is now coming back on the investors' radar. There is positive news flow as well. Brokerage action is positive and it's finally coming out of a lull.
So the whole pharma pack has very different, say, price charts. For example, you have a Laurus Lab, which is down 50%. And then you have something like a Cipla, which went up to new 52-week highs and has drifted lower. The only stock which comes in technical relative strength and which has held on well is the largest one, which is Sun Pharma. The stock has at least not seen a deep correction like the other names, and also the stock has done nothing for now almost 8 years. The stock was at 950 rupees back in 2014-15 as well. So out here, the risk reward as well as the relative strength in the near term is Sun Pharma, where I would like to go with. But the rest of the pharma pack, it's too early to call the bottom to be done. So I would only go with Sun Pharma, and that too would keep a stop loss below 900 on that one.
Okay, Sandeep, also wanted your take regarding the metal space as a whole, because this morning there seems to be a note coming in from Bank of America as well, and there is a commentary coming in that IMF believes that China is going to reopen, and that would mean a strong rebound in the second half of the year, and they are quite constructive on the metal space as a whole, and Tata Steel is their preferred pick. Would you concur with the view, Sandeep?
Steel has some positives going for them, given the recent uptick in prices. But overall, long term, overall directionally for the next 1 or 2 years, I would still think commodities will be under pressure given that the global economies will slow down. And even China, despite all the stimulus, etc., they are doing, they'll be just growing at 3 to 4% this year. So there's no strong rebound which is going to happen.
Nuresh, JSW or Jindal group of stocks, especially the steel companies, they are moving independently of what's happening in the world. SAIL, Tata Steel, other steel stocks are just puffy duffy. But these two names are JSW, JSPL and JSW Steel. They are like firm like rocks.
Yeah, so that has been the case. Finally, we see some bit of a decline in Jindal Steel. The stock was sustaining around that 580 to 600 mark, which is the previous high in the cycle of 2022. And now we've corrected to 520, 530. The last low for the stock is 520. So out here, Jindal Steel looks a risk reward trade wherein you have a strict stop loss at 520. But overall, yes, they've been a surprise pack in terms of the relative strength compared to the rest of the names. So that tells you that these are the stocks you want to be in and have a strict stop loss here, because as a sector, we know this has a tendency to see larger moves on both the sides. So for now, as of now, Jindal Steel looks interesting. JSW Steel has also made that sideways band for the last 2 years, but I would go with Jindal Steel as a buy at current levels.
Okay, let's get some mid-cap ideas as well going. Nuresh, you go first. What's on your list?
So that's a buy on GE Shipping, one of the few stocks which is actually holding on in the current market and gave a big, a volume tick yesterday in a big way. The stock saw a 3x to 4x volume jump up. The stock has given a breakout on a shorter term chart of the last few weeks, as well as has been on a longer term trending higher. The last breakout was at 550, 600, which got recently tested. So a price volume jump up as well as a confirmation on the longer term charts looks interesting. A quick target price of 700 and a stop loss to be placed at 605.
Right. Rudra, what about your mid-cap ideas?
For me, Sharda Cropchem looks very good on charts, and it is showing that clear patterns of accumulation. And whenever stock has just taken that support at levels of around 430, 440 zone, we have seen multiple bounce coming with strong support from volumes also. So for me, Sharda Cropchem is a buy. Looking at initial targets of 510, have a strict stop loss of 430 for this long call.
Right, okay, let's address some more stocks and index views, or rather India economy views. Here's JP Morgan Sanjay Mookim. He's released his latest note on India, and he's stating that improving macro is positive for banks particularly, and lower commodity prices are good for consumers. Pankaj is here with details from his note.
Well, you know, when we just look about what's happened with the latest report coming in from JP Morgan, this is the third to fourth report, which is talking about Nifty price to earnings multiple after the recent correction. And what Sanjay Mookim says is that Nifty headline PE is back to 2018-2019 levels. This is something which you had seen in the pre-pandemic era. Premiums to S&P 500, which they track, and emerging market index is something which has contracted quite significantly. This is after the recent underperformance that you have seen by the Indian market. However, they believe that reduction in the current account deficit, that's the CAD, has reduced macro concerns to a great extent, and that, according to them, makes them believe that things could look better as far as macro is concerned. And improving macro is always good for banks in general, and that's the key reason why banking is a part of their top pick list. As the global commodities or global markets slow down, you will see a commodity pressure, which is already visible in a lot of markets. So they say that lower commodity prices overall are good for consumption, and that's why they believe banking and consumption could do well. They like staples and two-wheelers. However, the traditional FMCG is something which they would be slightly neutral on in this point of time. Two-wheelers and staple is something which they like. They've given about 8 to 10 names and given one-line thesis why they like those names. So some of the names that I could pick up is Bajaj Finance, where they are overweight. They are saying solid asset quality with product expansion is the key takeaway. DLF is strong sales momentum over the last few quarters. They expect it to continue. For HUL, there is a margin uptrend and gradual volume uptrend, and that is something which they believe should essentially do well. Paytm, according to them, will see net positive payment margins, and that's the key thing which they believe will lead to re-rating. Reliance, they believe capex should scale up in petrochem, telecom and retail will drive growth. And for SBI, they believe solid asset quality retail loan growth is something which provides them comfort.
Okay, Pankaj, thank you so much for that cover. But time now for some news fatafat. And first up is the latest update coming in from the banking crisis. Now, First Citizens is close to locking a deal to acquire the cash-strapped Silicon Valley Bank from the FDIC. This according to a news report. In fact, in the meantime, Centre issues fresh advisory to states and union territories to maintain optimum testing amid the recent flare-up in the cases. The advisory notes that a gradual but sustained increase in trajectory of COVID cases is being witnessed at the moment. The government has planned nationwide mock drills on April 10th and 11th to check the COVID readiness of various hospitals. Meantime, 2023 would be another challenging year with global growth slowing to below 3%. That's the word coming in from IMF. They cite that geopolitical tensions and monetary tightening as some of the key factors of the growth being a bit tepid. In the world of sports, Harmanpreet Kaur-led Mumbai Indians wins the inaugural edition of the Women's Premier League, registering a 7-wicket win over the Delhi Capitals at Mumbai's stadium as well.
Okay, and India's star boxers clinched gold medals at the Women's World Boxing Championships. Nikhat Zareen and Lovina Borgain rewrite records, outclassing their Vietnamese and Australian counterparts. In fact, Nikhat has become only the second Indian to bag multiple gold medals after legendary MC Mary Kom. And continuing India's glorious wins, Commonwealth Games champions Satvik Sairaj Rankireddy and Chirag Shetty have bagged the men's double title at the Swiss Open, beating China's that's Ren Xiangyu and Tan Qing in a summit clash at Basel. And in some worrying news, IPCC has issued warning for severe heat wave conditions in Maharashtra, followed by water scarcity and flooding as well. All of these combined pose grave risks to crop yields and food security. It further also suggested the possibility of water scarcity becoming a common issue in the state of Maharashtra. And over the weekend, ISRO's heaviest rocket carrying 36 UK satellites lifted its wings from Sriharikota. The 36 first-generation satellites weighing 5,800 kgs will be placed into a 450-kilometer circular orbit. This was also the second launch that ISRO performed for OneWeb, a UK-based company supported by the UK government and India's Bharti Enterprises.
All right, now we are set to open with a mild gap up. Rudamurthy, would you be buying today's gap up start? It should be in and around 17,000.
No, Nikunj, for me, market has that strong resistance on Nifty future at around 17,120. So post that again, you see resistances kicking in back at 17,230, 17,350. So seeing these multiple resistances, I am not in the buy camp. In fact, I won't be surprised if I see a sell-off to happen after this gap up. And once we break 16,800, you get the decisive confirmation that yes, market is headed downward and we might have a swift move towards those levels of 16,200 or even 16,000. But I will call this only one 16,800 16,800 breaks. So let this band of 16,800 to 17,350 get decisively broken either on the downside or on the upside before I make positional bets or directional bets on a huge way. But right now for me, till we break 17,350, this is a market on sell on rise, and I won't be surprised if today's gap up is used by bears to sell rather than buying.
Duresh, you're one of a erstwhile favorite, Tata Com. It's done rather well in the last couple of days. Is the stock headed towards a new breakout? I think we've discussed this one in the past. 1250, 1260. That's an important level for Tata Com.
So the last time it came very close to a breakout was in December, January. It tried to cross that 1350 mark, failed out on that one. Post that again, it's back to the lower end of the range, wherein 1150 to 1200 is a support. In the last three sessions, it has seen a little bit of a pull up and is now on verge of breaking a last 3-week high. So if it sustains about 1240, you have a place, you have a target of again going back to that 1350, 1400 mark. And there have been three bottoms in that 1150, 1200 zone. So looks promising at these prices. It's only the market trend not being great. Otherwise, this would be a good entry.
Let's take a look at the index calls coming this morning as well. As far as Nifty is concerned, it's a bit of a conscious view coming in from our technical experts this morning. It's a hold coming in from Kush as well as Naresh, whereas CA Rudramurthy believes that it is a good opportunity to book some profits if there's a rise in the stock market. So the consensus, moodometer on the Nifty seems to be a hold. For Nifty Bank as well, similar picture pretty much. It's a hold coming in from Naresh and Kush, while Rudramurthy believes sell on rise is the best strategy. So a consensus hold on the Nifty Bank as well.
Okay, a lot of other stocks also which are going to be in focus, and Lupin as well. The UK regulator has now issued a zero observation for their Pithampur unit, so maybe some relief comes by on Lupin, holding up 0.6% as we speak right now. Grasim over the weekend came out with news. They've acquired a 220-acre land at 255 crore rupees per unit for setting up a manufacturing plant there. Grasim is the other one which is going to be in focus, and let's just revisit what that stock is up to. A little bit tempered, down about 0.5% as we speak right now. What's Crompton Consumer and then Butterfly Gandhimati up to? It seems like it's a merger coming their way. 1.5% higher for CG Consumer. Butterfly Gandhimati, the first rates haven't kicked in there. BEL as well, a sizable order is what they won from the Indian Armed Forces, worth about 4,300 crore rupees. So BEL as well, it's holding up quite okay actually in an otherwise flat market. 1.6% higher for BEL as we speak right now. Campus, of course, continues in focus, and details of that block deal as well came by. So let's just focus on what that stock is up to. TPG, remember, sold that 7.6% stake. Society General as well as Fidelity were buyers for that block. About 1% higher for Campus Activewear as we speak right now. And Sun Pharma, after that upgrade coming in and after that IT security incidents occurring, Sun Pharma is still holding up about 0.7% as we speak right now. So bunch of stocks in focus, but yes, for the markets, it seems like it's going to be, Nikunj, the global cues which are going to call the shots from here, even though there is valuation comfort at an index and even selectively stock specific level.
Siasha, I think the global wrinkle per se, at least considering what it was 2-3 weeks ago, especially after the US regional banking crisis, is not that, it's not that nervous. The nervousness in the market, I think globally, clearly seems to be subsiding. Nobody is talking about a big blow up or a contagion like 2008. All that narrative actually is now on the back seat. Now the narrative is that how long will the Fed tighten? How long will the FI selling continue? Is this a compulsion which is at play? And how long will this annoying underperformance of Indian markets continue? Now that's the moot point per se. But with each passing day, I think one thing is very evident. Nobody wants to trade. The commitment levels are not there. Nobody is ready to take risk. Real good old-time investors who've got large portfolios, who've seen many of these cycles, they are quite hesitant to commit capital. Not that they are raising a lot of cash, but they're quite hesitant to commit capital. And the feeling of mid and small cap stocks sinking in, I think, is there. So the point I'm trying to bring out here is that if you look at the market purely from the lens of market behavior, low participation, no participation, little participation, no derivative action, FI selling in the cash market, FNO selling at in peak, these are typical telltale signs that the markets lack any kind of a luster or momentum, and that's how market bottoms are made. The second reason why market bottoms are made is that when you become cheap. So we've not become like a market which is available at a throwaway price, but you're reaching what could be called as historical averages. If you bought India during moments when you bought, let's say, index at historical average, which is 15 to 16 times, that data point will just come up on your screen, you've been rewarded in next 12 to 18 months. So that's my limited pitch, that we are really nearing that point where if you buy and hold for next couple of months, forget years, you may actually be rewarded. And that is a thought which is getting endorsed by a Citi, by a BofA, JP Morgan today, CLSA last week, that the risk reward ratio now is turning favorable. It is turning favorable for Indian markets. There you go. You've got Surendra Goyal, you've got BofA, you've got Vikas, and you've also got JP Morgan, where everybody now seems to be endorsing the obvious that India's premium has contracted. Time to bet on India. That is what Big Four are saying. Do you bet it now? Do you bet on a bad day? Do you bet on a decline? That's anyone's guess. But time to bet on India. Time to bet on India, I think, is something which seems to be the universal appeal per se. First rates, any seconds now. It's a truncated week. It's an FNO expiry. It's the last week before we say goodbye to FY23 as a financial year. 67 points higher, 32 points higher for the Bank Nifty, 67 points higher for the Bank Nifty. The market breadth reasonably better. So we've not regained whatever we lost on Friday, but we are putting at a brave step forward. Folks, if global problems were causing the market sell-off, then trust me, the market would have recovered by now. We continue to underperform, and within seconds of a flat start, you got a print of red on the small cap index and the mid cap index. What do we have on the Nifty? Well, a flat start, no real strong active interest in any of the large cap stocks. If you want to address some of the AMC stocks, some of the banking stocks, that's about it. Mahindra & Mahindra, big downgrade there, and Kotak Mahindra, big upgrade there from CLSA. So those two stocks are individually reacting to news flow per se. But just a very anemic kind of a market, breadth hardly anything, price action hardly anything, and if anything at all, some of the haloed stocks like a Campus, Maneuver, all of them are just getting tossed around here and there.
Right, indeed. Campus is currently down by about 0.6%, and we just told you about the news on this one that TPG has sold at 7.6%, and it seems that Society Generale as well as Fidelity were buyers in that block. SBI Card, their total spends have come lower on a month-on-month as well as year-on-year basis. That stock is lower by about 0.5%. Zydus Life, the US FDA, has issued 3 observations at their Ahmedabad facility. And then Sun Pharma as well, even though there is a brokerage note upping their price target and call on Sun Pharma, the stock is a little bit soft right now as we speak because there is that IT security incident as well of a data leak at Sun Pharma, and I think that is souring the sentiment on the stock. Lupin, some positive news, and UK regulator has issued a 0 observation for their Pithampur unit. Stock is holding up 1% as we speak. BEL, after that 4,300 crore rupee order win. And then, of course, there is Crompton Consumer, the merger with Butterfly Gandhimati. They're looking to share 22 shares of the company for 5 in Butterfly. CG Consumer flat, Butterfly Gandhimati down 1.5% as we speak. What about the overall market? What's that settled in at? Extremely nimble this Monday morning, catching the Monday blues, just marginally higher, really struggling to even make it to that 17K mark. So pretty much a no-go so far. Naresh, does it seem like we could pick up at any point or at least take a direction?
Too tough to say because we're not seeing that uptick in the morning itself. But the fact is the same at 16,800 to 17,000. We are right in the middle. So till the time we hold 16,800, we could be more positive than negative. But it's only about 17,200. That is where the conviction comes into the market.
Okay, just looking at some of the other stocks as well, you have Phoenix Limited, which is up around 4% as we speak. There was a positive initiation this morning from Morgan Stanley, so the stock is higher by around 4%. Adani group of stocks are quite excited, so Adani Green Transmission are some of the names. As well as on the volume side, it's Balkrishna Industries, which is seeing heavy volumes already, so we are watching out for some of those names as well. And the entire MNC withholding tax increasing doesn't seem to be having a big impact, so whether it's HUL, Nestle, etc., they're all trading with the green. So that worry about the withholding tax going up from 10 to 15% is not having a big impact. But what about the first trade coming in from CA Rudramurthy? What are you strategizing?
See, for me, Indus India Bank looks weak. It has broken crucial support of 1030, 1040 zone. Every rise is getting sold into. So I'm looking at shorting Indus India Bank. Risk reward is very good at current price. So sell at current market price of around 1010 in futures. Look at target of around 940 to come in a week's time. And I'm keeping a strict stop loss of around 1030 for this sell call.
Naresh, what's your first trade stock specific recommendation?
So looking to buy on dips on G Shipping, the stock has opened up 1.5% higher, but looking out for the buy on dips on this one.